What if I told you that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully picked by the top experts on Wall Street? What if the endless stream of stock tips, sophisticated chart patterns, and confident forecasts from market gurus is nothing more than noise? A random, unpredictable dance of numbers with no discernible pattern at all. This is, without a doubt, the most controversial and infuriating idea in all of finance. It suggests that the entire multi-trillion-dollar industry of active money management is built on a foundation of illusion. It suggests that the time and energy you spend trying to find the next hot stock or time the next market crash is completely wasted. But what if this radical idea is also the most liberating and empowering truth an investor can ever learn? What if accepting the randomness of the market is the key to freeing yourself from anxiety, from costly mistakes, and from the entire Wall Street machine? There was one man, a brilliant economist from Princeton University, who brought the full force of academic rigor to this question and came to a conclusion that shook the financial world to its core. Welcome to Capitura. Today, we are taking a journey through one of the most important, influential, and comprehensive investment guides ever written. We're going on a deep, audiobook-style tour of Burton Malkiel's masterpiece, A Random Walk Down Wall Street. This isn't just a book about a single theory. It's a complete education in the history of markets, the psychology of investors, and a practical, evidence-based strategy for building long-term wealth. Stay with us, because the wisdom in this book can provide you with a powerful and unshakable compass in the chaotic world of modern finance. Introduction: The Professor's Guide to Beating Wall Street by Not Playing Its Game. Burton Malkiel is not your typical Wall Street titan. He is a distinguished professor of economics at Princeton University, a former dean of the Yale School of Management, and a member of the Council of Economic Advisors. He is an academic, a scientist who approaches the market not with trader's gut, but with an economist's skepticism and a relentless focus on data and evidence. His book, first published in 1973 and updated numerous times since to remain current, is a product of a lifetime of research into a simple question: can anyone consistently beat the stock market? His famous and controversial answer is the random walk hypothesis. The theory states that, in the short run, the movement of stock prices is completely unpredictable. It is a random walk. Tomorrow's price change is no more predictable than the flip of a coin. Why? Because in a reasonably efficient market, all available information is already reflected in the current price. The only thing that can change the price is new, unpredictable information. And by definition, you cannot predict the unpredictable. This means that any attempt to find patterns in past prices, technical analysis, or to find undervalued stocks based on public information, fundamental analysis, is a statistically losing game. This idea was, and still is, heresy to the entire Wall Street establishment, which makes its living by selling the promise of expert stock selection and market timing. But Malkiel's argument, backed by decades of academic research, is devastatingly powerful. Why is this academic theory more important now than ever before in our world of meme stocks, crypto, and Robinhood traders? Because the modern market has become a supercharged, high-speed embodiment of the very chaos Malkiel described, and his advice is the ultimate shield. The random walk theory is the perfect intellectual weapon against the armies of day traders and YouTube chartists who claim to have a system for predicting short-term price moves. Malkiel's work shows with data that they are playing a game of chance, not skill. His book's deep and vivid history of speculative bubbles, from the tulip mania of the 1600s to the dot-com bust, provides a perfect historical lens through which to understand the modern manias in cryptocurrencies and meme stocks. It teaches you to recognize the classic signs of a bubble before you get swept up in the FOMO. His ultimate prescription: to stop trying to beat the market and instead buy and hold a low-cost, broadly diversified portfolio of index funds, has become a foundational strategy for millions of successful investors and is the bedrock of the entire FIRE movement. A Random Walk Down Wall Street is more than just a book about a single theory. It is a complete investor's education in one volume. Malkiel takes you on a fascinating tour through the history of financial markets. He explains the two great theories of valuation, the firm foundation of fundamentals and the castle in the air of psychology. He dissects the tools of the professionals and shows why they so often fail. And then he gives you a clear, practical, step-by-step guide to building a portfolio that will serve you for a lifetime. It is a book that respects your intelligence, arming you not with hot tips, but with a deep understanding of how markets actually work. It is an empowering message that liberates you from the impossible task of trying to outsmart the pros, and instead gives you a simple, proven, and powerful strategy to win the long game. In the chapters that follow, we will walk through Malkiel's entire argument, from the madness of crowds to the wisdom of diversification. This is your university course in common sense investing, chapter by chapter breakdown. Part 1, Stocks and Their Value. Chapter 1, Firm Foundations and Castles in the Air. Burton Malkiel begins his journey not with a chart or formula, but with a fundamental question. What is a share of stock actually worth? He explains that throughout history, there have been two main competing theories for how to answer this question. He calls them the firm foundation theory and the castle in the air theory. The firm foundation theory is a traditional, rational approach. It argues that every investment, whether it's a stock, a bond, or a piece of real estate, has a firm, underlying intrinsic value. This value is based on the present value of all the future cash flows that the asset is expected to generate. For a stock, this means analyzing the company's earnings, its dividends, its assets, and its future growth prospects to arrive at a hard, numerical estimate of its worth. The job of the investor is to calculate this intrinsic value, and then buy the stock only when its market price is significantly below that value. This is the world of fundamental analysis, the world of Benjamin Graham and Warren Buffett. The price of a stock will eventually and inevitably return to its firm foundation of value. The castle in the air theory, on the other hand, is all about psychology. It was famously articulated by the economist John Maynard Keynes. This theory argues that an asset's value is not based on some firm foundation, but on what people think it is worth. The successful investor is not the one who can best estimate intrinsic value, but the one who can best predict what the crowd will value in the near future. Keynes used the analogy of a newspaper beauty contest, where the goal was not to pick the face you thought was prettiest, but to pick the face you thought the most other people would pick. In this view, the game of investing is not about calculating value, but about anticipating mass psychology. You are trying to build a castle in the air, a narrative or a story that will capture the public's imagination and cause them to bid the price up. You then aim to sell your castle to a greater fool before the whole thing comes crashing down. This is the world of momentum, of narrative, of hype, and of speculation. The price of a stock is simply whatever people are willing to pay for it, and that can be completely detached from any underlying fundamental reality. Malkiel argues that the stock market is a constant battle between these two theories. Sometimes the firm foundation logic prevails, and the market is a rational weighing machine. At other times, especially during periods of speculative mania, the castle in the air theory takes over, and the market becomes a wildly irrational voting machine. The successful long-term investor must understand both of these forces. Modern takeaway. This framework is a perfect lens for understanding the deep philosophical divide in modern markets. Firm foundation investors. These are the modern followers of Warren Buffett and Benjamin Graham. They are looking for high-quality businesses with strong earnings and are trying to buy them at a reasonable price. They believe that, in the long run, the value of Apple or Microsoft will be determined by their profits, not by market sentiment that castle in the air builders. The modern market is overflowing with these. The entire meme stock phenomenon is a pure castle in the air event. The value of GameStop at $400 a share was not based on any firm foundation of its business prospects. It was based on a powerful story, a community, and a belief that other people would continue to buy it. The same is true for the vast majority of cryptocurrencies. The price of Dogecoin is a castle in the air, built on memes and celebrity tweets. Its value is purely a function of mass psychology. Malkiel's framework teaches us to ask a crucial question about any asset we buy. Am I playing a firm foundation game, or am I playing a castle in the air game? Both games can be profitable, but the castle in the air game is far more dangerous and requires you to be a master of psychology and timing. For most people, Malkiel will argue, the firm foundation approach is the much safer path. Chapter 2, the madness of crowds. After introducing the castle-in-the-air theory, Malkiel now takes us on a thrilling and terrifying tour of what happens when that theory runs wild. This chapter is a historical account of the greatest speculative bubbles in history, and it is a masterclass in psychology of crowd madness. He starts with the most famous bubble of all, the tulip bulb mania, in 17th century Holland. He tells the incredible story of how the price of a single rare tulip bulb escalated from a simple flower to a luxury good, and finally to an object of insane speculation, with a single bulb trading for more than the price of a grand estate on the Amsterdam canals. People from all walks of life, merchants, servants, sailors, abandoned their jobs to become tulip traders. They were not buying the bulbs for their beauty. They were buying them based on the simple belief that someone else would pay an even higher price tomorrow. It was a classic castle-in-the-air bubble, completely detached from any intrinsic value. And of course, it ended in a spectacular and devastating crash that ruined thousands. He then moves on to the South Sea Bubble in 18th century England. The South Sea Company was a British company that was granted a monopoly on trade with South America. Based on exaggerated and often fraudulent claims about the potential riches from this trade, its stock price soared. The public was whipped into a frenzy of speculation. Even the great scientist Sir Isaac Newton was caught up in the mania, losing a fortune. The bubble eventually burst, leading to a massive financial crisis and a public outcry. Through these and other stories, Malkiel identifies the common characteristics of a speculative bubble, a compelling new narrative or a new technology that captures the public's imagination, easy access to credit or leverage, which fuels the buying pressure to a flood of new, inexperienced investors who are drawn in by the stories of easy riches, that a complete abandonment of traditional valuation metrics. People start to say, "This time it's different." The chapter is a powerful cautionary tale. It shows that for centuries, humans have been susceptible to these waves of irrational exuberance. The names of the assets change, but the underlying psychology of the crowd, the greed, the FOMO, the herd mentality, is a constant. Modern takeaway. Malkiel's historical accounts read like a perfect script for the financial manias of the last 25 years. The dot-com bubble, 1999 to 2000, this was a classic Malkiel bubble. The new paradigm was the internet. There was a flood of new retail investors. And there was a complete abandonment of valuation, with companies being valued on eyeballs instead of earnings. The crash that followed was a modern echo of the South Sea bubble. The cryptocurrency booms and busts. The world of crypto has been a series of spectacular bubbles and crashes. Each cycle has a new narrative: digital gold, smart contracts, NFTs, DeFi. Each cycle draws in a new wave of hopeful investors. And each cycle ends in a painful crash as the castle in the air comes back down to earth. Malkiel would see the rise and fall of Bitcoin from $69,000 as just the latest chapter in a very old story. The meme stock mania, 2021, the frenzy around GameStop and AMC, was a compressed, high-speed version of the tulip mania. It was driven by a powerful narrative, apes versus hedgies, fueled by commission-free trading and stimulus checks, and it attracted millions of new traders. The subsequent crash was just as predictable. This chapter is a form of psychological vaccination. By studying the madness of crowds in the past, you can learn to recognize the symptoms of a bubble in the present. This allows you to stand apart from the herd, to resist the siren song of FOMO, and to protect your capital from the inevitable crash. Chapter 3. Stock valuation from the 60s to the 90s. After showing us the dangers of pure speculation, Malkiel returns to the firm foundation theory. This chapter is a practical guide to the traditional methods of fundamental stock valuation and a historical review of how valuation trends have changed over time. He explains the key tools that a fundamental analyst uses to determine a stock's intrinsic value. The most important of these is the discounted cash flow, DCF, model. While the math can be complex, the idea is simple. A company's value is the sum of all the cash it is expected to generate for its shareholders from now until Judgment Day, with those future cash flows discounted back to their present value. He lays out 4 key rules that determine a company's fundamental value: the expected growth rate of earnings and dividends. The faster a company is expected to grow, the more it is worth. The expected dividend payout. The more cash a company returns to its shareholders, the more valuable it is. The degree of risk. A safe, stable business is worth more than a risky, unpredictable one. This is reflected in the discount rate used in the DCF model, the level of market interest rates. When interest rates are low, future cash flows are more valuable, which pushes stock prices up. When interest rates are high, stock prices tend to fall. He then walks through the market history of the latter half of the 20th century, showing how these fundamental factors played out. He describes a go-go 60s, a period where investors were obsessed with growth stocks and were willing to pay almost any price for them, leading to a nifty 50 bubble in large blue-chip growth stocks. He then describes a subsequent crash in the 1970s, when these high valuations came back to earth. This history serves as a practical illustration of how even the firm foundation theory can be subject to the wild mood swings of investors. People can become too optimistic about a company's future growth and end up overpaying, even for a great business. The chapter is a balanced and sober look at fundamental analysis. Malkiel believes in the firm foundation theory, but he is also a realist. He knows that our estimates of the future are always imperfect, and that the market can ignore fundamentals for long periods of time. Modern takeaway. The principles of fundamental valuation are timeless. A modern investor can use a DCF calculator or simply look at basic metrics to apply these ideas. The impact of interest rates. The market action of 2022 was a perfect, real-world lesson in Malkiel's fourth rule. For a decade, interest rates were near zero, which helped to justify the very high valuations of tech stocks and other growth assets. When the Federal Reserve began to aggressively raise interest rates in 2022, it was like a gravitational pull on those high-flying valuations. The value of their distant future earnings was discounted more heavily, and their stock prices fell dramatically. The Nifty 50 Echo, the bull market of the 2010s, created a new version of the Nifty 50 in the form of the FANG stocks, Facebook/Meta, Amazon, Apple, Netflix, Google. These were seen as one decision stocks that you could buy and hold forever, regardless of price. The painful bear market in many of these stocks in 2022, especially Meta and Netflix, was a reminder of Malkiel's point. No stock is a good investment at any price. Valuation always matters. GARP investing. Malkiel's framework naturally leads to a growth at a reasonable price. GARP, style of investing, similar to Peter Lynch. You want to find companies with strong growth prospects, but you must be disciplined about the price you are willing to pay for that growth. This chapter provides a fundamental toolkit for thinking about a stock's value. It grounds you in the realities of business performance and protects you from getting swept up in the purely psychological castle-in-the-air stories. Chapter 4, The Random Walk and the Efficient Market Hypothesis. We now arrive at the intellectual core of the book. In this chapter, Malkiel formally introduces the random walk hypothesis and its underlying theory, the efficient market hypothesis, EMH. This is where he makes his most direct and powerful case against a professional stock picker. He starts by defining a random walk. A random walk is a statistical term for a path that consists of a series of random, unpredictable steps. Malkiel argues that the short-term movements of stock prices are a random walk. This means that the past movement of a stock's price cannot be used to predict its future movement. A stock that has gone up for the last 3 days is no more or less likely to go up tomorrow than a stock that has gone down for the last 3 days. Each day's price change is a random, independent event. Why should this be true? This is where the efficient market hypothesis comes in. The EMH states that, in a competitive market with many smart participants, the price of a stock will always reflect all the available public information. The moment a new piece of information comes out, like an earnings report or a news story, the market reacts almost instantly, and the price adjusts to a new level that reflects that information. Therefore, the only thing that can move the price is new, unpredictable information. And since new information is by definition unpredictable, the resulting price movements must also be unpredictable. This means that any attempt to find an edge using old information, whether it's past price patterns, technical analysis, or public financial data, fundamental analysis, is futile. The information is already in the price. Malkiel discusses the 3 forms of EMH. The weak form states that you cannot predict future prices based on past prices. This is a direct attack on technical analysis. The semi-strong form states that you cannot beat the market using any publicly available information. This is an attack on most forms of fundamental analysis. The strong form states that not even inside information can help you beat the market, as the price reflects all information, public and private. Malkiel agrees that this form is likely not true, as insiders can undue profit from their knowledge. Malkiel presents a mountain of academic evidence to support the weak and semi-strong forms of the theory. Studies have shown that the track records of professional chartists and fundamental analysts are no better than what would be expected by random chance. His conclusion is radical and powerful. For the average investor, the game of trying to outsmart the market is a sucker's bet. The market is just too efficient. Modern takeaway. The random walk and efficient market hypotheses are the intellectual foundation for the entire passive investing revolution. If you cannot consistently beat the market, then the most logical thing to do is to simply buy the market through a low-cost index fund. This is a core argument that both Malkiel and John Bogle made. How does this theory hold up in the modern world of high-speed trading? The rise of quants and HFD. Malkiel would argue that the rise of quantitative funds and high-frequency trading has actually made the market even more efficient. These algorithms are designed to find and exploit any tiny, temporary mispricing in a matter of microseconds. This makes it virtually impossible for a human trader to compete on a short-term basis. The random walk is now happening at the speed of light. The challenge from behavioral finance. The main challenge to the EMH comes from the field of behavioral finance, which Malkiel will discuss later. We know that investors are not always rational. They are driven by fear and greed, which can create bubbles and crashes, periods where the market is clearly not efficient. The practical truth, Malkiel's modern take, and he updates the book regularly, is a balanced one. He acknowledges that the market is not perfectly efficient. There are anomalies and behavioral quirks. But he argues that these are very difficult for the average investor to exploit, and that for all practical purposes, the EMH is a very useful and accurate model of how the market works most of the time. The random walk is the best assumption to base your investment strategy on. Part 2, How the Pros Play the Game. Chapter 5, Technical Analysis and the Random Walk Theory. After laying out the random walk hypothesis, Malkiel now uses it as a weapon to dissect the two main strategies that professionals and amateurs use to try and beat the market. In this chapter, he takes on technical analysis, also known as charting. He explains the core philosophy of the technical analyst. They believe that all the fundamental information about a company is already reflected in its price. Therefore, the only thing we're studying is the price movement itself. They look at charts of past prices, searching for patterns, trends, and indicators that they believe can predict the future. The chartist creed is, the trend is your friend. They believe that stock prices move in predictable trends and that a trend once established is likely to continue. Malkiel describes a colorful and often mystical world of the chartist. He explains some of their classic tools and patterns. Support and resistance levels. The idea that a stock will have trouble moving above a certain resistance price or below a certain support price. Chart patterns. The famous head and shoulders pattern that supposedly signals a top, or the cup with handle that signals a breakout. Moving averages. The idea that if a stock's price crosses above its 200-day moving average, it is a buy signal, and if it crosses below, it is a sell signal. Malkiel, the rigorous academic, is deeply skeptical of all of this. He argues that if the random walk hypothesis is true, then all of these patterns are just optical illusions. The human brain is a pattern recognition machine. It is brilliant at finding patterns even in completely random data. He compares a chartist to a person seeing shapes in the clouds. The patterns are in the mind of the beholder, not in the data itself. He then presents the results of numerous academic studies that have tested the predictive power of technical analysis. The overwhelming conclusion of these studies is that it does not work. The buy and sell signals generated by these technical rules do not produce returns that are any better than a simple buy and hold strategy, especially after accounting for the transaction costs of all the extra trading. He concludes that technical analysis is a pseudoscience, an exercise in financial astrology that has no real predictive power. Modern takeaway. Malkiel's critique of technical analysis is a direct assault on a massive and growing industry, the YouTube/TikTok chartist. Today, the internet is flooded with self-proclaimed technical analysis gurus. They post videos with charts covered in dozens of colorful lines and indicators, making confident predictions about the next move in Tesla, Bitcoin, or the S&P 500. Malkiel would view these individuals as modern-day snake oil salesmen. He would point to the academic evidence and argue that their track records, if they were ever honestly published, would be no better than random chance. The limits of backtesting. Many modern technical traders use sophisticated software to backtest their strategies. They can show that a particular moving average crossover strategy would have worked brilliantly in the past. Malkiel would be skeptical. He would warn of data mining, the practice of testing thousands of different rules until you find one that happened to work in the past purely by luck. He would argue that a rule that is curve-fitted to past data is unlikely to work in the future. The self-fulfilling prophecy. The one defense of technical analysis that Malkiel acknowledges is that it can sometimes become a self-fulfilling prophecy. If enough traders all believe that $50,000 is a key support level for Bitcoin, they will all place their buy orders there, and this collective action can actually cause the price to bounce at that level. However, this is a game of psychology, not a science of prediction. Malkiel's message is a liberating one. It tells you that you don't need to spend years trying to master the complex and questionable art of charting. You can safely ignore it and focus on a much simpler and more proven path. Chapter 6. Fundamental Analysis and the Random Walk Theory. After dismantling technical analysis, Malkiel now turns his critical eye to the other major school of thought, fundamental analysis. This is a world of the firm foundation theory, the practice of trying to find undervalued stocks by analyzing their earnings, assets, and growth prospects. This is the approach of Graham, Buffett, and Lynch. Malkiel has a much greater respect for fundamental analysis than for technical analysis. He agrees that a company's stock price is ultimately tied to its fundamental value. However, he argues that beating the market through fundamental analysis is also an extremely difficult, if not impossible, game to win. This is the semi-strong form of the efficient market hypothesis in action. He lays out three main reasons why fundamental analysis often fails to produce superior returns. Information is transmitted too quickly. In the modern world, any new piece of fundamental information, an earnings report, a new product announcement, is disseminated around the globe in an instant. By the time you, the individual investor, read about it in the news, the professional analysts and algorithms have already reacted, and the information is already reflected in the stock's price. It is very difficult to get an informational edge. Your analysis can be wrong. Forecasting a company's future earnings is an incredibly difficult and uncertain task. Even the top Wall Street analysts with all their resources are notoriously bad at it. Their forecasts are often just an extrapolation of the recent past, and they are constantly surprised by unforeseen events. The market can be wrong. Even if your fundamental analysis is perfect and you have correctly identified an undervalued stock, the market can simply ignore your brilliant analysis for years. A stock can remain undervalued for so long that you give up in frustration. As Keynes famously said, the market can remain irrational longer than you can remain solvent. Malkiel concludes that while fundamental analysis is a valuable tool for understanding a business, it is not a reliable tool for generating market-beating returns. The competition is just too fierce, the future is too uncertain, and the market is too unpredictable. The efficient market takes care of most of the opportunities before the average person can act on them. Modern takeaway. The challenges of fundamental analysis that Malkiel described have only intensified in the modern era. The information arms race. The speed of information is now measured in microseconds. High-frequency trading firms co-locate their servers in the same data centers as the stock exchanges just to get a few milliseconds advantage in reacting to news. An individual investor has absolutely no chance of competing in this information game. The rise of quantamental funds. Many modern hedge funds are now quantamental, combining the deep fundamental research of human analysts with the massive data processing power of AI and machine learning. They are analyzing satellite images of parking lots to forecast retail sales, scanning social media for sentiment shifts, and building incredibly complex models. This raises the bar for what it takes to get a fundamental edge to a nearly impossible level for the amateur, the narrative-driven market. In today's market, the castle-in-the-air theory often dominates the firm foundation theory for long periods. A stock like Tesla can trade at a valuation that seems completely disconnected from its fundamentals for years, driven by a powerful narrative and a charismatic leader. A pure fundamental analyst who shorted the stock based on its valuation would have been destroyed. Malkiel's conclusion is not that fundamentals don't matter. They are the long-term anchor of a stock's value. But his point is that trying to use public fundamental information to find temporary mispricings is a game that is very, very hard to win. Chapter 7. How Good Are the Pros? This is Malkiel's Put Up or Shut Up chapter. He has argued, based on theory, that both technical and fundamental analysis should not be able to consistently beat the market. Now, he presents the empirical evidence of how professional investors, the mutual fund managers who are paid millions to do this for a living, have actually performed. He looks at the long-term track record of actively managed mutual funds, and the results are a brutal confirmation of the efficient market hypothesis. The data is overwhelming and comes from multiple academic sources, including the fund's own performance records. The key findings are: the vast majority of mutual funds underperform a simple, unmanaged market index like the S&P 500 over any meaningful long-term period. The percentage of underperformers is often 80 to 90% over a 10 or 15-year period. There is no persistence in performance. The top-performing funds of one decade are highly unlikely to be the top-performing funds of the next. The winners are constantly rotating, suggesting that their outperformance was due to luck, not skill. This is the same conclusion that John Bogle reached. The reason for the underperformance is simple: costs. The average fund charges an expense ratio and incurs transaction costs. This cost drag creates a high hurdle that is almost impossible to overcome consistently over the long run. Malkiel is essentially making the same data-driven case that Bogle made in the Little Book of Common Sense Investing. He is showing with irrefutable evidence that the entire active management industry as a whole is a loser's game. He is not saying that there are no skilled managers at all. He acknowledges that a few, like Warren Buffett or Peter Lynch, seem to have demonstrated genuine, long-term skill. But he argues that the odds of an individual investor successfully identifying these few geniuses in advance are astronomically low. For every one Peter Lynch, there are 1,000 mediocre managers who will underperform. His conclusion is a practical one. Since it is nearly impossible to pick a winning fund manager, and since the average fund manager is guaranteed to underperform a market after costs, the most logical and rational strategy is to fire all the managers and simply buy a low-cost fund that mechanically tracks the market index. Modern takeaway. The evidence that Malkiel presented has only gotten stronger over time. The SPIVA scorecard, the SPIVA S&P Indices versus Active scorecard, published regularly by S&P Dow Jones Indices, is the modern Bible on this topic. It consistently shows that the vast majority of active managers in every category, large cap, small cap, international, fail to beat their respective benchmarks over the long run. The data is a running confirmation of Malkiel's and Bogle's thesis. The decline of the star manager, the era of the star mutual fund manager like Peter Lynch, has largely faded. The modern financial world is dominated by giant, anonymous teams and increasingly by passive index funds and ETFs. The market has become so competitive and efficient that it is harder than ever for a single human manager to consistently display an edge. The hedge fund story. The same story of underperformance is true for the high-priced world of hedge funds. Over the last decade, a simple, low-cost S&P 500 index fund has massively outperformed the average hedge fund, which charges exorbitant fees. This chapter is a powerful dose of reality. It forces the reader to confront the data and to question the core premise of the entire active investment industry. If the highly paid professionals with all their resources can't beat the market, what makes us think we can? Part 3. The New Investment Technology. Chapter 8. Modern Portfolio Theory, MPT. Having made his case for the random walk, Malkiel now moves into more constructive part of the book. If you can't beat the market by picking stocks, how do you build an intelligent portfolio? In this chapter, He introduces a foundational concept of modern investment science, modern portfolio theory, MPT. MPT was developed by the Nobel Prize-winning economist Harry Markowitz. It is a mathematical framework for building a portfolio that maximizes your expected return for any given level of risk. The core insight of MPT is incredibly powerful and can be summed up in one word: diversification. Malkiel explains that the risk of portfolio is not just the average risk of the individual stocks within it. The magic of diversification comes from combining assets that do not move in perfect lockstep with each other. If you own two stocks that are perfectly correlated, they always go up and down together. You have not reduced your risk at all. But if you own two stocks that are uncorrelated, their movement are independent. You can create a portfolio that has a much lower risk than either of the individual stocks. He uses a simple example. Imagine an island economy with only two companies, a resort hotel and an umbrella manufacturer. The hotel does well when it's sunny. The umbrella maker does well when it's rainy. If you invest all your money in the hotel, your returns will be very volatile. If you invest all your money in the umbrella maker, your returns will also be volatile. But if you invest 50% in each, you'll create a portfolio with much more stable, predictable returns, because the bad year for one business is a good year for the other. This is the free lunch of diversification. MPT takes this simple idea and turns it into a science. It shows that by combining different asset classes, like U.S. stocks, international stocks, bonds, real estate, etc., you can build a portfolio with a much better risk-adjusted return. The goal is to find efficient frontier, which is a set of portfolios that offer the highest possible return for each level of risk. The key takeaway is that an investor should not think about their individual stocks in isolation. You must think about how they work together as part of a larger portfolio. The goal is not to find the best individual stock, but to build the best, most diversified portfolio of assets. Modern takeaway. Modern portfolio theory is the intellectual bedrock of all modern asset allocation and financial planning. The Boglehead 3-fund portfolio. The classic Boglehead 3-fund portfolio, U.S. stocks, international stocks, and bonds, is a direct and practical application of MPT. U.S. stocks and international stocks are not perfectly correlated, and stocks and bonds are often negatively correlated. Bonds tend to do well when stocks do poorly. By combining these three asset classes, you create a simple, robust, and highly diversified portfolio. Robo-advisors. Modern robo-advisors like Betterment and Wealthfront are built entirely on the principles of MPT. Their algorithms use your risk tolerance to select a specific portfolio on the efficient frontier, using a diversified mix of low-cost stock and bond ETFs from around the world. Diversification in the crypto world. The concept of diversification is slowly making its way into the crypto world. An investor might decide not to put all their money in Bitcoin, but to also own some Ethereum and other altcoins with different use cases, in the hope that they will not all move in perfect lockstep. This chapter provides a scientific why behind the common sense advice to not put all your eggs in one basket. It is a foundation for building a sound long-term investment plan. Chapter 9, Risk and Return. Building on the principles of modern portfolio theory. This chapter explores a fundamental relationship between risk and return. Malkiel introduces another key concept from modern finance, the capital asset pricing model, CAPM. He explains that there are two types of risk in the stock market. The first is diversifiable risk, or specific risk. This is the risk associated with a single company, the risk that its CEO might quit, its new product might fail, or its factory might burn down. MPT shows that this type of risk can be almost completely eliminated by owning a well-diversified portfolio of many stocks. The second type of risk is systematic risk, or market risk. This is the risk that is inherent in the overall stock market itself. The risk of a recession, a war, or a major change in interest rates. This type of risk cannot be diversified away. No matter how many stocks you own, you will still be exposed to the ups and downs of the broader market. The CAPM model introduces the concept of beta. Beta is a measure of a stock's systematic risk. It measures how volatile a stock is relative to the overall market. The market as a whole has a beta of 1. A stock with a beta of 2 is twice as volatile as the market. It is expected to go up 2% when the market goes up 1% and down 2% when the market goes down 1%. These are high-risk, high-return stocks that a stock with a beta of 0.5 is half as volatile as a market. These are low-risk, low-return stocks, like a stable utility company. The core idea of the CAPM is that the market will only reward you for taking on a risk that you cannot diversify away. The systematic risk. You do not get a higher expected return for taking on a specific risk of owning a single stock. This is another powerful argument for diversification. The only way to get a higher long-term return is by taking on more market risk, either by owning a portfolio of high beta stocks or by using leverage. Malkiel's conclusion is that investors need to understand what kind of risk they are taking on. By building a diversified portfolio, you can eliminate the uncompensated risk of individual stock blowups. Then, you can decide how much compensated market risk you are comfortable with, which will determine your long-term expected return. Modern takeaway. The concept of beta is a standard metric used by investors today. You can find the beta for any stock on websites like Yahoo Finance. High beta stocks. Modern high-growth tech stocks and speculative assets are typically high beta. A stock like Tesla or a cryptocurrency like Bitcoin has a very high beta. They tend to have spectacular runs in a bull market and catastrophic crashes in a bear market. An investor who owns these is taking on a lot of systematic risk, and they should expect a wild ride. Low beta stocks. Boring consumer staples companies like Procter & Gamble or healthcare giants like Johnson & Johnson are typically low beta stocks. They tend to underperform in a roaring bull market, but hold up much better during crash. They are the defensive corner of the market, the rise of smart beta. The modern investment industry has created a whole category of smart beta ETFs that try to build portfolios based on specific factors, such as low volatility, low beta, or high quality. These are an attempt to use the insights of modern finance to build better than market cap-weighted indexes. This chapter provides a more sophisticated framework for thinking about risk. It teaches us that not all risk is created equal, and that the intelligent investor's goal is to eliminate the uncompensated, diversifiable risk, and then to choose a level of compensated market risk that aligns with their personal goals and temperament. Chapter 10, Behavioral Finance. In this chapter, Malkiel addresses the biggest challenge to the efficient market hypothesis, the undeniable fact that investors are not always rational. He introduces the fascinating field of behavioral finance, which combines insights from psychology and economics to understand why investors so often behave irrationally. He acknowledges that the pure EMH, which assumes that all investors are rational Mr. Spocks, is not a perfect description of reality. We are all human, and we are all susceptible to a host of psychological biases that can lead us to make systematic errors. He walks through some of the most important of these biases. Overconfidence. Most people believe they are above average drivers, and most traders believe they are above average investors. This overconfidence leads them to trade too much, to take on too much risk, and to believe they can outsmart the market. Herding. We are social creatures, and we find safety in numbers. This leads to the herd mentality that drives speculative bubbles. When everyone else is getting rich in a meme stock, the psychological pressure to join the herd is immense. Loss aversion. Psychological studies have shown that the pain of a loss is about twice as powerful as the pleasure of an equivalent gain. This loss aversion is what causes investors to hold on to their losing stocks, because selling would mean realizing the painful loss, and to sell their winning stocks too early, to lock in pleasure and avoid the pain of it turning into a loser. Confirmation bias. We tend to seek out and pay attention to information that confirms our existing beliefs and to ignore information that contradicts them. A Tesla bull will read all the positive news stories and dismiss all the negative ones as FUD. Anchoring. We tend to get anchored to a particular price, like the price we paid for stock. This can prevent us from selling a loser because we are waiting for it to get back to even. So, if investors are so irrational, doesn't this mean the market is inefficient and easy to beat? Malkiel's answer is a crucial no. He argues that while these biases create temporary pockets of irrationality, it is very difficult to consistently profit from them. First, the very biases that affect other people also affect you, making it hard to be the rational one. Second, even if you identify a bubble, it can continue to inflate for years, and betting against it can be financial suicide. His final conclusion is a balanced one. Behavioral finance explains why the market can sometimes be irrational, but the efficient market hypothesis still holds as the best practical guide for the average investor. The market is not perfectly efficient, but it is efficient enough that trying to beat it is a very dangerous game. Modern takeaway: the modern market is a giant, real-time laboratory for behavioral finance. Overconfidence and herding on steroids, the Robinhood app with its gamified interface, and Reddit's Wall Street Bets forum with its tribal, apes-together strong mentality, are powerful engines for overconfidence and herding. They create a social feedback loop that encourages risky, speculative behavior. Laws of aversion and diamond hands. The diamond hands meme is a fascinating modern manifestation of loss aversion. It is a social creed that pressures people to never sell, no matter how far a stock has fallen. This is loss aversion weaponized by a community. The crypto echo chamber. Crypto Twitter is a perfect example of confirmation bias. Each crypto tribe lives in its own information bubble, consuming only the news and opinions that confirm their belief in their chosen coin, making them blind to risks and alternative viewpoints. This chapter teaches us that the greatest risks in the market often come from within. By understanding these common psychological biases, you can learn to recognize them in your own thinking and behavior. This self-awareness is your best defense against the madness of crowds and the fool in the mirror. Chapter 11. Can you beat the market? This is Malkiel's concluding chapter for the theoretical part of the book. He sums up all the evidence and arguments he has presented and delivers his final verdict on the question of whether an investor can consistently beat the market. His answers are firm but nuanced. Probably not. He recaps the evidence. Technical analysis. The academic studies are overwhelming. Charting and technical analysis have no predictive power. It is a loser's game. Fundamental analysis. While fundamentally sound, it is extremely difficult to get an informational or analytical edge in a highly competitive and efficient market. The professional track record. The data is clear. The vast majority of professional fund managers fail to beat their benchmark index over the long run, primarily due to costs. He then revisits the challenges from behavioral finance. He acknowledges that the market is not perfectly efficient. There are anomalies. There are bubbles. There are times when stocks are clearly mispriced due to human emotion. So, can a savvy investor exploit these? Malkiel is skeptical. He argues that while anomalies like the small firm effect or the value effect have existed in the past, they tend to disappear once they are discovered and widely publicized. The very act of trying to exploit an inefficiency makes the market more efficient. His final conclusion is a pragmatic and humble one. While it might be theoretically possible for a tiny handful of exceptionally skilled and disciplined investors like a Warren Buffett to beat the market over time, the odds of the average individual investor or the average professional manager doing so are extremely low. For the vast majority of us, the attempt to beat the market is a costly and ultimately futile endeavor. It is a game that is not worth the candle. Therefore, the most logical, rational, and common-sense strategy is to give up the game and instead buy the entire market through a low-cost index fund. He is not saying this is the most exciting strategy. He is saying it is the smartest strategy. It is the one that is most likely to lead to long-term financial success. Modern takeaway. This chapter's conclusion is the intellectual foundation for the entire passive investing revolution and the FIRE movement. It is a logical endpoint of all the evidence presented. The rise of passive dominance. The flow of money in the investment world tells a story. For the last 2 decades, trillions of dollars have flowed out of high-cost, actively managed mutual funds and into low-cost, passive index funds and ETFs. Investors are, in essence, voting with their feet and agreeing with Malkiel's conclusion that challenge to the modern stock picker. This chapter is a direct challenge to the modern culture of individual stock picking that have been fueled by Robinhood and social media. Malkiel is essentially saying to this new generation of traders, the data shows that you are playing a losing game. The odds are overwhelmingly against you. Are you sure you wouldn't be better off just buying an index fund? The exception that proves the rule. The few investors who have had spectacular success, like the early investors in Tesla or Bitcoin, are the exceptions that prove the rule. For every one of them, there are thousands who lost everything betting on the wrong story stock or crypto project. Malkiel's strategy is not about hitting the lottery. It's about guaranteeing a winning ticket for the long-term growth of the entire economy. Part 4. A practical guide for random walkers and other investors. Chapter 12. A life cycle guide to investing. Having convinced us that indexing is the smartest path, Malkiel now shifts into practical how-to section of the book. This chapter is a comprehensive guide to asset allocation based on an investor's age and life stage. He argues that your personal financial plan should be tailored to your specific circumstances, and the most important factor is your risk tolerance, which is heavily influenced by your age and your ability to earn future income. He lays out a simple, sensible life cycle model for investing. The young investor, 20s and 30s a young person, has the single greatest asset of all, a long time horizon. They have decades of future earnings ahead of them. This means they can afford to take on more risk in pursuit of higher returns. Malkiel suggests that a young investor's portfolio should be heavily weighted towards stocks, perhaps 80 to 90% in stock index funds, and only 10 to 20% in bond index funds. They should embrace market volatility as an opportunity to buy more shares at cheaper prices. The mid-career investor, 40s and 50s, as you get older, your time horizon shortens, and your focus should begin to shift from pure growth to a balance of growth and capital preservation. Malkiel suggests gradually becoming more conservative, perhaps moving to a 60-40th or 70-30th stock/bond split. You still need growth to outpace inflation, but you also need to start protecting the wealth you have already built. The retiree, 60s and beyond, once you are in retirement, your primary goal is to preserve your capital and generate a steady stream of income to live on. Your portfolio should be at its most conservative, perhaps 40% stocks and 60% bonds, or even more conservative depending on your needs. The stocks provide the long-term growth to protect your purchasing power from inflation, while the bonds provide the stable income and a cushion against market crashes. He also introduces the idea of automatic investing and rebalancing. He is a huge proponent of setting up an automatic monthly investment plan, dollar cost averaging, to enforce discipline and take emotion out of the equation. He also advises rebalancing your portfolio back to its target allocation once a year to systematically sell high and buy low. Modern takeaway. Malkiel's life cycle guide is a foundational model for almost all modern financial planning and is a core strategy used by the FIRE movement. Target date funds. The easiest way to implement Malkiel's life cycle plan is with a target date retirement fund. These all-in-one funds automatically adjust their asset allocation to become more conservative as you approach your target retirement date. They are a perfect hands-off embodiment of his advice. The FIRE movement's aggressive stance. Many followers of the FIRE movement, who are aiming for a very early retirement, adopt an even more aggressive stance than Malkiel might suggest, often holding 90 to 100% in stocks well into their 30s and 40s. They are maximizing their exposure to growth in order to reach their financial independence number faster. This is a higher risk version of his modeled out robo-advisors. Modern robo-advisors are also built on this life cycle principle. When you sign up, they ask you for your age and retirement goals, and then they construct a diversified portfolio with a stock/bond mix that is appropriate for your life stage. This chapter provides a simple, actionable, and time-tested blueprint for building a portfolio that is right for you. It is a practical application of all the theory that has come before. Chapter 13, 3 Giant Steps Down Wall Street. In this chapter, Malkiel provides a simple, 3-step action plan for putting his investment philosophy into practice. It is a get-started-now guide for the beginner investor. Step 1. Start saving now. The first and most important step has nothing to do with the stock market. It is about your personal finances. Malkiel stresses that you cannot build wealth without a foundation of regular savings. He advises you to set up a disciplined savings plan and to start as early as possible to take advantage of the miracle of compound interest. He also recommends building up a cash emergency fund to cover unexpected expenses, so you'll never be forced to sell your long-term investments at an opportune time. Step 2. Use tax-sheltered retirement plans. Malkiel is a huge advocate for using tax-advantaged retirement accounts like 401k, and IRAs, individual retirement accounts. He explains that the ability for your investments to grow tax-deferred or tax-free is a massive, powerful advantage that can add hundreds of thousands of dollars to your nest egg over a lifetime. He advises you to contribute the maximum amount possible to these accounts every year, especially if your employer offers a matching contribution, which is free money. Step 3. Choose your investment mix. This is where the random walk comes in. For the vast majority of your investment portfolio, especially within your retirement accounts, he recommends a simple mix of broad market, low-cost index funds. He gives a few simple portfolio recipes. A U.S. Total Stock Market Index Fund, an International Total Stock Market Index Fund for diversification, a U.S. Total Bond Market Index Fund. He also discusses adding a small allocation to a real estate investment trust, REIT, index fund for further diversification. He ends a chapter with a powerful message of encouragement. You don't need to be a Wall Street wizard to be a successful investor. You just need to follow these 3 simple, common-sense steps with discipline and patience over a lifetime. Modern takeaway. This 3-step plan is a universal blueprint for modern personal finance and is the exact strategy promoted by the FIRE movement. Step 1. The modern FIRE movement is built on a high savings rate, often 50% or more of one's income. This is Malkiel's first step, taken to an extreme. Step 2. The strategy of maxing out your 401k and IRA every year is a cornerstone of modern retirement planning advice. Step 3. The simple 3-fund Boglehead portfolio, composed of low-cost ETFs like VTI, VXUS, and BND, is the modern implementation of Malkiel's investment mix. This chapter is the ultimate quick start guide. It cuts through all the complexity and gives the reader a clear, actionable, and proven path to get started on their journey to financial security. Chapter 14, A Random Walk Down Wall Street and Across the World. In this chapter, Malkiel expands on the theme of diversification, arguing that in our increasingly globalized world, it is essential for investors to look beyond their own home country. He makes a powerful case for international investing. He points out that the U.S. stock market, while large, only represents about half of the world's total stock market capitalization. By only investing in U.S. stocks, you are ignoring a huge universe of great companies and growth opportunities in Europe, Asia, and emerging markets. He also explains that the different stock markets around the world are not perfectly correlated. The economy of Japan might be booming while the U.S. economy is in a slump and vice versa. By owning a mix of both U.S. and international stocks, you can further reduce the overall volatility of your portfolio. This is the same diversification logic from modern portfolio theory, but applied on a global scale. He advises investors to allocate a significant portion of their stock portfolio, perhaps 20 to 40%, to international markets. He acknowledges that international investing can be complex and risky for an individual trying to pick stocks in foreign countries. Therefore, he strongly recommends using a low-cost international index fund, or ETF. A total international index fund gives you exposure to thousands of companies in both developed and emerging markets, all in a single, simple vehicle. This chapter is about expanding the investor's horizon. In a world where economies are deeply interconnected, a purely domestic portfolio is no longer sufficient. Global diversification is the new standard for the intelligent investor. Modern takeaway. Malkiel's case for global diversification has become the consensus view in modern financial planning. The rise of global ETFs. The modern investor can achieve global diversification with a single click. ETFs like VT, Vanguard, Total World Stock ETF own the entire global stock market, both U.S. and international, in one simple, ultra-low-cost package. This is the ultimate buy the haystack strategy, but for the whole world, the lost decade in the U.S. The 2000s were a lost decade for the U.S. stock market, which ended the decade with negative returns. However, during that same period, emerging markets had a spectacular bull run. An investor who had a globally diversified portfolio would have had much better returns than a purely U.S.-focused investor. This is a real-world example of the benefits of international diversification. The modern Boglehead portfolio. The classic Boglehead portfolio is built on a foundation of global diversification, typically splitting the stock allocation between a U.S. total market fund, VTI, and an international total market fund, VXUS. This chapter teaches us that in the 21st century, a successful investor must be a global investor. Chapter 15, the grand finale. In his final chapter, Malkiel brings all of his advice together into a single, cohesive strategy. It is a how-to guide that is so simple and practical that he calls it a no-brainer guide to financial success. He lays out a step-by-step process that anyone can follow. He first reiterates the importance of the non-investment steps. Save aggressively, build an emergency fund, pay off your high-interest debt, and get insurance. Then he gets to the investment plan. He offers a few different simple, index-based portfolio recipes depending on the investor's desired level of involvement. The no-brainer single-fund solution. For the ultimate in simplicity, he recommends a single balanced target date retirement fund. This one fund automatically handles your asset allocation between stocks and bonds and across the globe, and it rebalances for you. It is a complete, diversified, hands-off solution. The build-your-own index fund portfolio. For those who want a bit more control, he lays out the simple recipe of combining 3 or 4 core index funds, a U.S. total stock market fund, an international total stock market fund, a U.S. total bond market fund, and perhaps a real estate REIT fund. He then gives a final, powerful piece of behavioral advice. Once you've bought your portfolio, you must resist the temptation to trade. He urges the reader to ignore the market's short-term noise, to avoid looking at their portfolio too often, and to have the discipline to stay the course for decades. He ends the book with an optimistic and empowering message. The path to financial security is not complex. It does not require genius or inside information. It requires only a basic understanding of a few key principles, a simple and sensible plan, and the discipline to stick with it. It is a game that is available to everyone, and it is a game that you can win. Modern takeaway. This final chapter is the ultimate practical playbook for the modern passive investor. It is the exact strategy that is at the heart of the FIRE movement and the Boglehead philosophy. The power of simplicity. In a world of infinite financial complexity, with crypto, NFTs, meme stocks, and thousands of thematic ETFs, Malkiel's call for radical simplicity is more powerful than ever. His no-brainer guide is a shield against all of this distracting and dangerous noise, the behavioral challenge. The final piece of advice, to resist the temptation to trade, is the hardest part for the modern investor. The Robinhood app, with its constant notifications and easy trading, is designed to make you do the exact opposite. The modern investor must actively fight against the tools that are designed to encourage bad behavior. This chapter is the culmination of the entire book. It is a simple, powerful, and evidence-based solution that Malkiel has been building towards. It is a plan for a lifetime of financial success, accessible to everyone. Modern context expansion. What would Burton Malkiel say today? If we were to sit down with Professor Malkiel today, and he is still writing and active, he would look at the modern market with the eyes of a scientist who is seeing his theories confirmed in the wild, but also with the concern of a teacher who sees his students making the same old mistakes with dangerous new toys. The random walk in hyperspeed. Vindication Malkiel would argue that the modern market is, in many ways, more efficient and more of a random walk than ever before. The information arms race. He would point to the speed of modern information dissemination and the dominance of high-frequency trading, HFD, and quantitative funds. These entities have turned the market into an information processing machine of incredible speed and power. The idea that an individual investor can find a piece of public information that isn't already in the price is more far-fetched now than ever. The death of alpha, he would point to the relentless data from the Spiva scorecards as the ultimate vindication of his thesis. The consistent, decades-long failure of the majority of active managers to beat the index is the real-world proof of the efficient market in action. A grand behavioral experiment. Concerned while he would feel vindicated on the efficiency front, he would be deeply concerned about the explosion in irrational, speculative behavior, seeing it as the largest behavioral finance experiment in history. The new castle-in-the-air factory. He would see the combination of commission-free trading apps like Robinhood, social media echo chambers like Reddit's Wall Street Bets, and the 24/7 nature of crypto markets as a perfect factory for building castles in the air. These tools amplify every psychological bias he wrote about, herding over confidence, FOMO, on a massive global scale. Meme stocks and crypto as bubbles. He would look at the GameStop mania and the wild boom and bust cycles in cryptocurrencies and see them as classic, textbook speculative bubbles, no different in their psychological lessons from the tulip mania he described in his book. He would warn that while these bubbles can make a few people rich, they are a brutal and efficient machine for transferring wealth from the many to the few on crypto as an asset. He would likely view Bitcoin and other cryptocurrencies with extreme skepticism. He would classify them as a pure castle-in-the-air asset, with no firm foundation of intrinsic value. He would acknowledge their impressive returns, but would point to their extreme volatility and the history of bubbles as proof that they are a speculation, not an investment. He would likely advise that they belong, if at all, in a tiny speculative corner of a portfolio, and that investors should be fully prepared to lose their entire stake. The triumph and perversion of indexing Malkiel would have a complex view of the modern ETF landscape. Vindication. He would be thrilled to see that his core recommendation to own the market through low-cost, broad market index funds has become the dominant strategy for millions of people and is the foundation of the FIRE movement. Concern. He would be deeply worried about the perversion of his idea. He would echo Jack Bogle's concerns about the explosion of narrow, thematic, leverage, and sector ETFs. He would argue that these instruments are betrayal of the core principle of diversification. They are tools designed to encourage market timing and speculative betting, turning the winner's game of indexing back into the loser's game of stock picking, but with a fancy new wrapper. His final message would be a powerful one. The financial industry has created more complex and tempting ways to lose money than ever before. Therefore, the need for a simple, disciplined, and evidence-based strategy of broad diversification and long-term thinking is not just relevant. It is a matter of financial survival. Closing reflection. 10 timeless steps on the random walk. As we conclude our walk down Wall Street with Burton Malkiel, we are left with a powerful and coherent philosophy of investing. It is a philosophy grounded in academic rigor, historical perspective, and profound common sense. It is a strategy designed not for geniuses, but for everyone. Let's distill his comprehensive wisdom into 10 timeless steps. Trust in the random walk. Accept that short-term market movements are unpredictable. Stop trying to outsmart the market through stock picking or market timing. This acceptance is the first step toward true investment wisdom. Recognize the madness of crowds. Study the history of speculative bubbles. Learn to recognize the signs of irrational exuberance, a hot narrative of new investors, and an abandonment of valuation. This knowledge is your best defense against FOMO. Diversification is the only free lunch. The single most powerful tool for risk reduction is diversification. Own a broad mix of different asset classes, U.S. stocks, international stocks, bonds, and real estate, to build a more stable and resilient portfolio. Manage your risk. It's the only thing you can control. You cannot control the market's returns, but you can control the amount of risk you take. Your asset allocation between stocks and bonds is the most important investment decision you will ever make. Costs matter. Keep them low, always. The relentless rules of humble arithmetic are undefeated. The lower the fees and expenses you pay, the greater your share of the market's return will be. Low-cost index funds are the ultimate tool for minimizing costs. Your own behavior is your biggest enemy. Master your own psychology. Understand the powerful biases, like overconfidence, herding, and loss aversion, that lead investors to make systematic errors. Your temperament is more important than your intellect. Trust in the long-term growth of the economy. The long-term trend of the market is driven by the fundamental growth of corporate earnings and human innovation. Have faith in this long-term upward trajectory, and do not be shaken by short-term volatility. Start saving early and invest automatically. The most powerful force in the universe is compound interest. The sooner you start, the more powerful it will be. Set up an automatic investment plan to enforce discipline and take emotion out of the equation. Keep it simple. A simple portfolio of a few broad market index funds is superior to a complex portfolio of individual stocks, actively managed funds, and exotic alternatives. Simplicity leads to better behavior and better results. Stay the course. This is the ultimate key to success. Once you have created a sensible long-term plan, have the discipline and fortitude to stick with it through good times and bad. The market will test your resolve. Those who endure will be rewarded. How can you apply these lessons right now? Malkiel makes it incredibly easy. Determine your risk tolerance and use his life cycle guide to choose your target asset allocation between stocks and bonds. Open an account at low-cost brokerage. Build your portfolio using a handful of the simplest, broadest, and lowest-cost index funds or ETFs available, e.g., a total world stock market fund and a total world bond market fund. Set up automatic contributions from your paycheck. By taking these simple steps, you have implemented a sophisticated, evidence-based investment strategy that is statistically likely to outperform the vast majority of professionals over the long run. You're taking a random walk, and you have won the game. Outro/subscribe CTA. And so our random walk down Wall Street comes to an end. We are left with a message of profound intellectual honesty and practical wisdom from Professor Burton Malkiel. It's a message that frees us from the pressure of having to be a market genius, and instead gives us a clear, simple, and proven path to building wealth. It is the ultimate guide to winning the long game. If you found value in this breakdown of a random walk down Wall Street, make sure to subscribe Capitura, because next we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and stay the course. Capitura logo appears on screen as the music fades out. You are an expert financial educator and YouTube scriptwriter. Write a 12,000 to 15,000 word long-form YouTube script in English for my channel Capitura. The script must feel like an audiobook-style deep summary of the given finance/trading book. Book input: Technical analysis of stock trends, the original Bible of charting, full audiobook. Book name, author name. Technical analysis of stock trends, Robert D. Edwards and John McGee. Script requirements: Introduction, 800 to 1,200 words. Hook the listener with a strong opening line. Introduce the author and the background of the book. Explain why this book still matters today. Show how the book's wisdom can be applied in modern markets. Mention FOMO, meme stocks, ETFs, crypto, FIRE movement. Chapter by chapter breakdown, 9,000 to 11,000 words. Summarize every chapter in detail, 800 to 1,000 words per chapter. Use clear, simple storytelling. After each chapter, add modern-day investing examples, Robinhood culture, Tesla hype, Bitcoin bubbles, passive investing, etc. Connect old wisdom to today's trading psychology and financial world. Modern context expansion, 2,000 to 2,500 words. Imagine what the author would say if they saw today's markets. Compare traditional investing with current strategies, index funds, day trading, quant models, AI-based investing. Explain timeless principles and how they protect against modern risks. Closing reflection, 700 to 1,000 words. Summarize 10 timeless lessons from the book. Explain how the average investor can apply them right now. Encourage patience, discipline, and long-term thinking. Outro/subscribe CTA, 150 to 250 words. Smoothly end with a motivating call to action. If you found value in this breakdown of book title, make sure to subscribe Capitura, because next we're covering another classic that can completely change how you think about money and markets. Tone and style: clear, engaging, educational. Mix of serious insights plus motivational delivery. Avoid financial advice or guarantees. Flow should feel like a professional narrator guiding the audience through a powerful journey. Word choice and style instructions: avoid overused AI words/phrases. Embark, delve, venture, navigate, unveil, harness, unlock, pave the way. Embarking on a journey, deep dive. Use natural human alternatives. Start, explore, look into, discover, reveal, use, open, build. Let's break down, go step by step. Use simple, direct, and natural language where possible. Keep the script engaging without sounding robotic. Ensure sentences flow logically for an AI or human narrator to read easily. Show thinking. Of course, following the established pattern of in-depth audiobook-style analysis, here's a complete, long-form YouTube script for Capitura on Edwards and McGee's technical analysis of stock trends. Video opens with a sophisticated, intricate track. Visuals show the jagged lines of stock chart being drawn in real time, which then resolve into recognizable geometric patterns. triangles, rectangles, and a clear head and shoulders top. The patterns glow, revealing a hidden structure within the chaos. The channel logo, Capitura, is displayed briefly. Narrator: what if the stock market has a language? A universal language, written not in words or numbers, but in the simple, elegant patterns of price and volume. What if every boom and every bust, every speculative mania and every quiet accumulation leaves behind a distinct footprint on the chart? And what if you could learn to read this language, to understand the story the market is telling you, and to anticipate its next major move before it happens? This is a promise of technical analysis, the art and science of reading charts. To many, it seems like a form of financial astrology, an attempt to find meaning in random squiggles. But to its practitioners, it is a powerful discipline, a way of decoding the single most important force in the market, human psychology. It is based on a simple but profound idea, that the patterns of fear, greed, hope, and panic that drive markets are timeless, and they repeat themselves over and over again in predictable ways. And for nearly 80 years, one book has stood as the undisputed Bible of this discipline. It is a foundational text, the Old Testament of charting, a book that has trained generations of traders to see the hidden order within the market's apparent chaos. Welcome to Capitura. Today, we are not looking at balance sheets or economic forecasts. We are learning to read the tape. We are taking an audiobook-style journey through the original and most definitive guide to charting ever written. Technical Analysis of Stock Trends by Robert D. Edwards and John McGee. This isn't just a summary of chart patterns. It is a deep immersion into philosophy and the practical application of technical analysis from its founding fathers. Stay with us, because the principles in this book will give you a new and powerful lens through which to see the market forever. Introduction: the grammar of the market's language. First, let's understand the legends behind this seminal work. The story begins with Charles Dow, the founder of Dow Jones and Company and the Wall Street Journal. In the late 19th century, he began writing editorials that laid out a set of principles for understanding the stock market, which became known as Dow theory. This was the first serious attempt to formalize the study of market trends. Robert D. Edwards, a student of Dow theory, took these foundational ideas and, in the first edition of this book in 1948, systematically cataloged and described the classic chart patterns that Dow theory hinted at. Then came John McGee, the man who turned the theory into a practical art form. McGee was an engineer by training who became a legendary trader and technical analyst. He joined Edwards for the book's second edition and added his invaluable insights on practical application, risk management, and trading tactics. The combination of Edwards' encyclopedic knowledge of patterns and McGee's real-world trading wisdom is what turned this book into the enduring classic it is today. It is a work built on decades of empirical observation of what actually works in the real world. Why does a book written in the age of slide rules and ticker tape still matter in the age of algorithms and instant information? Because its subject is not technology. Its subject is people. The patterns that Edwards and McGee identified are not magical shapes. They are pictures of mass human psychology. A head and shoulders top is a visual story of a bull run losing momentum, of hope turning to anxiety, and finally to panic. A triangle is a picture of a market in equilibrium, coiling with tension before a decisive breakout. These psychological dramas are as real today as they were in 1948. Think about the modern market. The classic chart patterns described in this book appear every single day on the price charts of Tesla, Nvidia, and every other major stock. They appear on the charts of ETFs, commodities, and currencies. The principles of support and resistance are the fundamental building blocks that every cryptocurrency trader uses to navigate the extreme volatility of Bitcoin and other digital assets. The book's entire philosophy of trend following, of buying strength and selling weakness, is a direct antithesis of the buy the dip mentality that traps so many new traders on Robinhood, causing an average down into oblivion, even for a passive investor in the FIRE movement. Understanding the basic grammar of trends can provide the psychological context to stay the course during a bear market, or to recognize the signs of the speculative top and perhaps take a little risk off the table. Technical analysis of stock trends is not a get-rich-quick system. It does not promise certainty. What it provides is a language, It gives you the grammar and the vocabulary to read the story that the market is telling. It teaches you how to identify high probability, low risk entry points, how to manage your trades with discipline, and how to align yourself with the market's major trends. It is a book that seeks to replace gambling with a structured, methodical approach to speculation. In the chapters that follow, we will walk through the entire edifice of classical charting, from its philosophical foundations in Tao theory to the nitty-gritty details of every major chart pattern. We will learn not just what the patterns look like, but the human psychology that creates them. And after each section, we will connect these timeless patterns to the real-world charts and the market dynamics you see today. This is your masterclass in the language of the market. Let's begin. Chapter by chapter breakdown. Part 1, the technical theory. Chapters 1 to 3, the foundations Tao theory. Edwards and McGee begin their masterwork, not with a chart pattern, but with a philosophy. The first several chapters are dedicated to explaining the foundational principles of all technical analysis. Tao theory. Developed by Charles Tao at the turn of the 20th century, Tao theory is a set of logical tenets that provide a framework for understanding the overall health and direction of the stock market. It is a constitution upon which all the specific laws of charting are built. Tao theory can be distilled into 6 core principles. The averages discount everything. This is a cornerstone of all technical analysis. It states that the market price of a stock or an index reflects everything that is known, felt, or hoped for about that security. All the fundamental data, all the economic forecasts, all the insider knowledge, and all the human emotion are summed up in a single number, the price. Therefore, the study of the price action itself is all that is required. The market has 3 trends. Tao saw the market as moving in a series of waves, like the ocean. He identified 3 levels of trend. The primary trend. This is the major, long-term direction of the market, the main tide. A primary bull market is a broad upward movement that lasts for a year or more. A primary bear market is a long-term downward move. The secondary trend. These are the intermediate corrections within the primary trend, like the waves on the tide. In a bull market, a secondary trend is a correction that might last a few weeks or months before the primary uptrend resumes. The minor trend. These are the day-to-day fluctuations, the ripples on the waves. Tao considered these to be unimportant noise. The technician's main job is to identify and trade with the primary trend. Primary trends have 3 phases. Tao observed that major bull and bear markets tend to unfold in 3 distinct psychological phases. A bull market consists of Phase 1, accumulation. This is when the smartest investors begin to buy, sensing that the bad news is already priced in and a recovery is coming. Phase 2, public participation. This is the longest phase, where business conditions are improving, earnings are rising, and the general public starts to get on board. Phase 3, distribution. This is a final euphoric phase, where speculation is rampant, the news is all good, and the smart money from Phase 1 is now selling their shares to the excited public. The opposite 3 phases occur in a bear market: distribution, panic, and discouraged selling. The averages must confirm each other. Dow created 2 indexes: the Dow Jones Industrial Average, representing the industrial, producing part of the economy, and the Dow Jones Rail Average, now the transportation average, representing the shipping part of the economy. He believed that for a new primary trend to be confirmed, both averages must signal it. If the industrials break out to a new high, but the transports fail to do so, it is a non-confirmation and a warning sign. Volume must confirm the trend. Volume, the number of shares traded, is a crucial secondary indicator. In a healthy bull market, volume should increase as prices rise and decrease as prices fall. Heavy volume on a price decline is a bearish sign that a trend is assumed to be in effect until it gives definite signals that it is reversed. This is the core principle of trend following. An object in motion tends to stay in motion. The technician's job is not to predict when a trend will end, but to ride it until the evidence of reversal is clear and undeniable. Modern takeaway. While Dow theory is over a century old, its principles are still remarkably relevant. The averages discount everything. This is the philosophical basis for the modern efficient market hypothesis. In today's high-speed market, this principle is more true than ever. News about Tesla's production numbers or Federal Reserve interest rate decision is priced into the market in a matter of seconds. Confirmation of the averages. Modern technicians still use this principle. They look for confirmation between different indexes, like the S&P 500, representing large cap stocks, the NASDAQ, representing technology and growth, and the Russell 2000, representing small cap stocks. If the NASDAQ is making new highs but the Russell 2000 is lagging badly, it can be a warning sign that the market's rally is not broad-based and may be vulnerable. The three psychological phases of a bull market perfectly describe the life cycle of modern speculative bubbles. The Bitcoin bull run of 2020 to 2021 followed this script exactly. An accumulation phase by early believers, a long public participation phase as it gained mainstream acceptance, and a final euphoric distribution phase with meme coins and celebrity endorsements, which marked the top. Dow theory gives you the psychological map to understand these manias. Chapter 4 to 8, Classic Reversal Patterns. After laying the philosophical groundwork of Dow theory, Edwards and McGee now move to the heart of their work, the identification and analysis of the classic chart patterns. They begin with reversal patterns. The specific formations that signal a major primary trend is about to end in reverse direction. Being able to spot these patterns is a crucial skill, as it can help you get out at the top of a bull market or get in at the bottom of a bear market. The most important and reliable of all reversal patterns is the head and shoulders top. This pattern, as its name suggests, looks like a silhouette of a person's head and shoulders on the chart. The left shoulder, after long uptrend, the stock makes a new high and then pulls back on a wave of profit-taking. The head, the stock then rallies again, pushing to an even higher high than the left shoulder, but this time, the volume is often lower, a subtle sign of weakness. It then falls back again. The right shoulder, the stock attempts one more rally, but this time it fails to reach the height of the head. This is a critical moment of failure, the sign that the buyers are exhausted. The neckline, a trend line can be drawn connecting the lows of the two pullbacks between the shoulders and the head. The breakdown, the reversal is confirmed when the stock price breaks down below the neckline, especially on a surge in volume. This is a definitive signal that the uptrend is over and a new downtrend has begun. Edwards and McGee explain the psychology of the pattern beautifully. The left shoulder and head are part of a normal, healthy uptrend, but the failure of the right shoulder to make a new high is the first clear evidence that the balance of power is shifting from the bulls to the bears. The breakdown below the neckline is the final confirmation that the bears have won the battle. They also describe the inverse version, the head and shoulders bottom, which is a powerful signal of the end of a bear market. They then cover other important reversal patterns. Rounding tops and bottoms. These are slow, gradual reversals that look like a saucer or an inverted bowl. They represent a slow and deliberate shift in sentiment from bullish to bearish or vice versa. Triangles as reversal patterns. While usually continuation patterns, a triangle that forms after a very long and extended trend can sometimes act as a top or bottom. The key takeaway is that major trend reversals rarely happen on a dime. They are a process, not an event. These classic patterns are the footprints left behind by that process. The visual evidence of the slow, grinding battle between buyers and sellers that occurs at every major market turning point. Modern takeaway. These classic reversal patterns are still some of the most widely watched and traded formations in modern markets. The 2021 top in speculative tech. Many of the high-flying tech stocks that peaked in 2021, including the famous ARK Innovation ETF ARKK, formed massive and clear head and shoulders top patterns throughout that year. A technician who recognized this pattern would have had a clear warning signal to get out long before the devastating crash of 2022, the Bitcoin top. The price chart Bitcoin in 2021 also formed a classic double top reversal pattern, another formation Edwards and McGee discuss, with two peaks at around $65,000 and $69,000, which signaled the end of that epic bull run. Spotting bottoms. Conversely, the bottom of the S&P 500 bear market in October 2022 was marked by what many technicians saw as a messy but valid inverse head and shoulders bottom, which signaled the beginning of a new bull market that followed. This chapter teaches you to read the story of a market top or bottom. Instead of trying to guess the exact peak, you learn to wait for the evidence of a reversal to build. as shown by these time-tested patterns. It is a powerful tool for avoiding the final, most dangerous distribution phase of a bull market. Chapters 9 to 11, Classic Continuation Patterns. After teaching us how to spot the end of a trend, Edwards and McGee now focus on the patterns that signal a trend is likely to continue. These are called continuation patterns. They are periods of temporary pause or consolidation within a larger, ongoing bull or bear market. Being able to recognize these patterns is crucial for finding low-risk entry points to get on board an established trend. The most important continuation patterns are triangles. A triangle is a pattern where the trading range gets progressively narrower over time, with the price coiling like a spring, building up energy for its next big move. Edwards and McGee described three main types. Symmetrical triangles. These are formed by a series of lower highs and higher lows that converge toward a single point. They represent a state of pure equilibrium and uncertainty between buyers and sellers. The subsequent breakout, which can be in either direction, is usually decisive. Ascending triangles. These are formed by a horizontal top line resistance and a rising bottom line support. This is a bullish pattern. It shows that the sellers are holding firm at a certain price, but the buyers are getting progressively more aggressive, buying at higher and higher prices on each dip. It suggests the buyers are likely to win and push the price through the resistance level. Descending triangles. This is the inverse of the ascending triangle, with a horizontal bottom line and a falling top line. It is a bearish pattern, suggesting that a breakdown is more likely. Another important category of continuation patterns are rectangles, also known as trading ranges or boxes. This is simply a period where a stock trades sideways between a clear support level and a clear resistance level. It represents a long pause in the trend. The eventual breakout from the rectangle, either up or down, usually signals a resumption of the prior trend. Finally, they discuss the short-term but powerful continuation patterns known as flags and pennants. These are small, compact patterns that form after a very sharp, almost vertical price move. A flag looks like a small, downward-sloping rectangle, that a pennant looks like a small symmetrical triangle. These patterns represent a brief, orderly pause as the market catches its breath before continuing its explosive move in the same direction. Modern takeaway. These continuation patterns are the bread and butter of modern swing traders and trend followers. They are constantly looking for these setups to add to existing positions or to initiate new ones. Triangles in crypto. The price chart Bitcoin is famous for forming massive, multi-month triangles. For example, in 2020, before its massive bull run from $10,000 to over $60,000, Bitcoin spent months coiling in a large ascending triangle. The breakout from that pattern was a starting gun for the entire bull market. Rectangles and stalwarts, large, mature stocks like Microsoft or Apple will often spend months or even years trading sideways in a large rectangle before beginning their next major leg up. A patient technician will wait for the breakout from that range as a low-risk entry point. Flags and momentum stocks. You can see bull flags form almost every day in a stock that is in a powerful uptrend, like Nvidia has been during the AI boom. After a sharp 10% rally, the stock will pause for a few days, forming a small flag, before resuming its climb. These are classic entry points for momentum traders. This chapter gives you the tools to identify a trend in progress and to find a safe place to jump on board. Instead of chasing a stock after it has already had a huge run, you learn to wait for one of these consolidation patterns to form, providing a much lower risk and higher probability entry point. Chapter 12 to 16, Other Key Technical Concepts. In this section of the book, Edwards and McGee cover several other essential tools and concepts that a technician uses to analyze the market. These are the building blocks that support the analysis of the major patterns. The most fundamental of these concepts are support and resistance. Support is a price level where a stock has trouble falling below. It is a level where the buying interest is strong enough to overcome the selling pressure. This often occurs at a previous low point on the chart. Resistance is the opposite, a price level where a stock has trouble rising above. It is a level where the selling pressure is strong enough to overcome the buying pressure, often at a previous high point. They explain that these levels are a representation of the market's memory. Traders who bought a previous high and are now sitting on a loss are often eager to sell when the price gets back to their break-even point. which creates resistance. Understanding where these key support and resistance levels are is crucial for setting price targets and stop losses. A fascinating aspect they note is that once a resistance level is decisively broken, it often becomes a new support level and vice versa. Next, they discuss the importance of trend lines. A trend line is a simple line drawn on a chart that connects a series of rising lows in an uptrend or a series of falling highs in a downtrend. It is a visual representation of the trend's direction and steepness. As long as the price stays above the uptrend line, the trend is considered intact. A decisive break below the trend line is a warning signal that the trend may be changing. They also discuss trend channels, which are formed by drawing a parallel line to the main trend line, creating a channel in which the price tends to oscillate. Finally, they touch upon other important technical phenomena like gaps, areas on a chart where no trading occurred, often caused by overnight news, and the concept of moving averages. A moving average is a continuously updated average price over a specific time period, e.g., the 50-day or 200-day moving average. It is a tool for smoothing out the short-term price fluctuations and seeing the underlying trend more clearly. A stock trading above its 200-day moving average is generally considered to be in a long-term uptrend. Modern takeaway. These concepts are the absolute bedrock of modern technical analysis. Support and resistance in all markets. Every single crypto trader, forex trader, and stock trader in the world is watching key support and resistance levels. When you hear an analyst on CNBC say, the S&P 500 is approaching key support at the 5,000 level, they are using this exact concept. These levels become powerful self-fulfilling prophecies because so many people are watching them. Trend lines and channels. Modern charting software makes it incredibly easy to draw trend lines and channels. A swing trader might buy a stock like Tesla when it pulls back to its long-term uptrend line, seeing it as a low-risk buying opportunity. The 200-day moving average. The 200-day moving average has become one of the most widely watched technical indicators. Many institutional funds have rules that forbid them from owning a stock that is trading below its 200-day moving average. When an entire market, as represented by the S&P 500 ETF SPY, breaks below its 200-day moving average, it is often seen as the official signal of a new bear market. This section provides the essential, practical tools of the technician's trade. Learning to identify these simple lines and levels on a chart can dramatically improve your ability to define your risk and identify high-probability entry and exit points. Part 2. Trading Tactics. John McGee's contribution. Chapters 17 to 21. The Practical Art of Trading. After the dense, encyclopedic review of chart patterns, the book shifts gears. This is a section where John McGee, the practical trader, takes over. He moves from the what to the how. How do you actually use these patterns and concepts to make money, and more importantly, to not lose money? This section is a masterclass in risk management and trading psychology. McGee's philosophy is one of a cautious and professional operator. He is not a gambler. He is a risk manager. He lays out a series of practical rules and considerations for the serious trader. Develop a trading plan. McGee is adamant that you must have a clear, written plan before you enter a trade. Your plan should specify your entry point, your stop-loss exit point, where you will get out if you are wrong, and your profit target or your criteria for exiting a winning trade. Trading without a plan is just gambling. Risk management is paramount. This is McGee's central message. He says that a trader's first job is not to make money, but to preserve capital. He introduces the concept of the stop-loss order. He argues that you must know, before you enter a trade, exactly how much you are willing to lose. You should place a stop-loss order to automatically exit the trade if the price hits that level. This is a mechanical, unemotional way of cutting your losses, and it is a key to long-term survival. The importance of the line of least resistance. He echoes Livermore's philosophy. Don't fight the market. Your job is to identify the primary trend and align yourself with it. He says, the trend is your friend. Selection and diversification. McGee advises against over-diversification. He believes a trader should concentrate their capital on a handful of the most promising ideas that they have thoroughly analyzed. He also advises sticking to stocks in strong, leading industry groups. A rising tide lifts all boats. Psychology and patience. He He talks about the psychological challenges of trading. He stresses the importance of patience, the patience to wait for the perfect A-plus setup, and the patience to hold on to a winning trade. He also talks about the need for emotional detachment. You cannot let your hopes or your fears dictate your actions. You must follow your plan with cold, unemotional discipline. This section of the book is what elevates it from a simple encyclopedia of chart patterns to a true Bible of trading. It is the wisdom of a seasoned professional who has survived decades of battles with the market. It is a powerful and timeless guide to the practical art of risk management. Modern takeaway. McGee's practical advice is the foundation of every successful modern trading system. The trading plan. Every single professional trader today, from a hedge fund manager to a successful independent crypto trader, operates with a detailed trading plan. The stop loss. The stop loss order is the single most important tool for any active trader. In the modern world of extreme volatility, especially in meme stocks and crypto, trading without a stop loss is an act of financial suicide. The trader who bought GameStop at $400 without a stop loss was destroyed. The trader who bought it and placed an 8% stop loss lived to trade another day. The psychology of the Robinhood trader. McGee's warnings about emotion are a perfect diagnosis of the modern Robinhood culture. The rapid, impulsive, planless trading that is so common on these platforms is exactly the kind of emotional gambling that McGee warned against. This section is a call to professionalism. It teaches you that if you want to succeed as a trader, you must treat it like a serious business. You need a plan, you need a ruthless approach to risk management, and you need the discipline of a professional. Modern context expansion. What would Edwards and McGee say today? If we could bring the founding fathers of technical analysis, Robert Edwards and John McGee, into the 21st century trading arena, they would be both astonished by the technology and deeply satisfied to see how enduring their principles have become. The vindicated chartist, their primary reaction would be one of profound vindication. They would be thrilled to see that the patterns they first identified by hand-plotting charts on graph paper are now being watched, analyzed, and traded by millions of people and even by sophisticated computer algorithms around the world. Proof of concept. They would argue that this is the ultimate proof that these patterns are not just random noise. They are real, recurring artifacts of human psychology. The fact that a head and shoulders pattern in a modern Bitcoin chart behaves in the exact same way as it did in a railroad stock chart from 1930 is proof that the underlying driver, the shift from hope to fear, is timeless. The language has become universal. They would be proud to see that their work created a universal language for traders. When a modern analyst on CNBC talks about a stock breaking out an ascending triangle, they are speaking the language that Edwards and McGee first codified. The new tools and the new arenas, they would be fascinated by the new tools and the new markets available to the modern technician. Charting software and AI. John McGee, the engineer, would be in heaven with modern charting platforms like TradingView. The ability to instantly test ideas, apply indicators, and analyze thousands of charts would seem like magic. They would likely view AI and algorithmic trading with great interest. They might argue that many of these algorithms are simply superfast, unemotional versions of themselves, programmed to recognize and execute trades based on the very patterns they discovered. This, they would argue, might even make the patterns more reliable as self-fulfilling prophecies. The crypto casino. They would see the cryptocurrency markets as the ultimate laboratory for technical analysis. Here is a market driven almost entirely by pure psychology, by fear and greed, with very little of the fundamental noise that can complicate the analysis of stocks. They would see the clean, beautiful trends and the classic textbook patterns in the Bitcoin chart as a perfect expression of speculative psychology. Meme stocks. They would view the meme stock phenomenon as a classic case study in market manias and blow-off tops. They would have used their patterns to identify the final, climactic run-up in GameStop and would have had clear, objective signals to get out long before the crowd did. A critique of modern charting. The indicator jungle, while they would be impressed by the technology, they would also likely be critical of one modern trend: the tendency to clutter charts with dozens of complex indicators. McGee, in particular, was a purist. He believed that the most important information was in the simple price action, the volume, and the basic trend lines. He would look at a modern chart covered in RSI, MACD, stochastics, Bollinger Bands, and Ichimoku clouds and argue that it is a form of analysis paralysis. He would urge modern traders to return to the simple, elegant, and time-tested wisdom of the basic patterns. Listen to the price, he would say, not to the indicator. Their timeless message would be clear. The game is faster, the tools are better, and the markets are global. But the underlying principles of trend, momentum, and human psychology are exactly the same. The language of the chart is still the most reliable story you can read. Closing reflection, 10 timeless laws of the chart. As we conclude our deep dive into the Bible of technical analysis, we are left with a complete and coherent system for interpreting the market's behavior. Technical analysis of stock trends is not a book of magic. It is a book of logic, observation, and discipline. It is a grammar book for the language of the market. Let's distill its profound wisdom into 10 timeless laws of the chart. The chart tells a story. The price chart is not a random wiggle. It is a visual record of the battle between buyers and sellers, a minute-by-minute account of the interplay of hope, greed, and fear. Learn to read that story. The trend is your friend until it ends. The market moves in trends, and a trend in motion is likely to stay in motion. Your highest probability trades will always come from aligning yourself with the primary trend, not from fighting it. History repeats itself because human nature is constant. The chart patterns that worked 100 years ago still work today because the underlying human emotions that create them have not changed. The game is different, but the players are the same. Price discounts everything. All known information is reflected in the price. Stop getting distracted by the news and the narratives. Focus on the reality of the price action. The tape is the ultimate truth. Volume confirms the price. Price and volume must be analyzed together. A price breakout on high volume is a confirmation of strength. A price breakout on low volume is a warning sign. Volume is a gas in the tank of a trend. Recognize the market's memory, support, and resistance. Past turning points on a chart create psychological levels of support and resistance. These levels are the key to identifying risk and reward, to setting stop losses, and to finding logical entry points that a pattern is a picture of a battle. A chart pattern, like a triangle or a head and shoulders, is not a mystical signal. It is a logical, visual representation of a period of equilibrium or a shift in power between the bulls and the bears. Understand the psychology and you will understand the pattern. The goal is not prediction, but probability. Technical analysis does not offer certainty. It is a tool for identifying situations where the odds are in your favor. The professional trader is a risk manager who plays the probabilities, not a fortune teller who predicts the future. Manage your risk or you will be removed from the game. John McGee's ultimate lesson is that capital preservation is a trader's first and most important job. You must have a plan, you must know where you are wrong, and you must cut your losses without hesitation. Technical analysis is an art, not a science. While it is built on a foundation of logical principles, the application of technical analysis requires judgment, experience, and flexibility. It is a skill that is developed over years of dedicated practice and observation. How can you apply these lessons right now? The first step is to start looking at charts. Open a free charting platform like TradingView. Pull up a long-term chart of a famous company like Apple or a market index like the S&P 500. Can you identify the last major uptrend? Can you draw a simple trend line that connects the lows? Can you see a past price peak that acted as resistance? Don't try to make predictions. Just observe. Your goal is to start training your eye to see the market in this new, visual way. Start to see the stories, the battles, and the trends that are hidden in plain sight. This is the first step on the long but rewarding journey of becoming a master chartist.